Hello. Let me welcome you to the session on solutions for recent measurement challenges, contributed session F. I'm the chair, Leonard Nakamura. Other presenters are Pete Lee of ONS and Mark Grunwald of Liverpool University. And I will now, if you have any questions, please put them into the Q&A. There will be 10 minutes left after each presentation for answering questions. Pete, would you kick it off? Thank you.
Thank you, Leonard. Good afternoon, everybody. I am Pete Lee. I work in the National Accounts area at the ONS, and I'm just about to share my screen. So just bear with me one moment. And hopefully you can see my slides. Okay, so what I'm going to talk about is some work that my colleagues and I at the ONS and also at the Bank of England have carried out looking at the challenges around measurement of gold and of crypto assets within the national accounts. So I'm going to talk a little bit about the issue and the history, what the current treatment is, and why there are challenges and consequences around that. Some of the international engagement work that has been taking place, and a proposal we have come up with for treatment in the future for these commodities. So calling it a problem definition, which kind of jump into the idea that it is a problem. Just a little bit of history on how gold has been treated within the national accounts and through the sequence of SNAs. It should be noted that the balance of payments treatment has been more consistent over time, and the two have come into line. So going back to the 68 SNA, any gold held by monetary authorities was classed as financial gold within the financial account, as was gold used as a store of wealth, whereas gold used for industrial purposes, so for manufacturing, was classified as industrial gold as an inventory or within intermediate consumption. In subsequent SNAs in 93 and 2008, financial gold held by monetary authorities became monetary gold, stayed in the same position. The industrial gold was classified as non-monetary, again, inventory or intermediate consumption. The change was gold that was being used as a store of wealth, which had previously been financial gold, and then moved to being classified as non-monetary gold as a valuable within the capital account. And crypto assets, of course, well, previous SNAs didn't really envisage crypto assets, so those challenges are newer, and we'll need to develop treatments for those kinds of things. But focusing on gold to start with, and the current treatment, the flowchart will show, if the gold is held by a monetary authority as reserve asset, it's straightforward. It's monetary gold. If it's not, it's classed as non-monetary. Is it there to act as a store of wealth? It's a valuable. Is it used as a commodity in production? That's straightforward. It's intermediate consumption. But is it used for speculative and hedging purposes? Well, then it appears, particularly within exports and imports, be inventories, valuables, and so on. So this is the area that causes a particular issue for us. So why is the current treatment of gold problematic? And it wouldn't be problematic in all countries, but certainly for countries like the United Kingdom with large gold exchanges and so on. The chart on the left is trading goods of precious metals, which includes non-monetary gold. We can't quite identify non-monetary gold because it's disclosive, but it is the key driver there. And at times of economic uncertainty, of which have been quite a few over recent years, you've seen enormous volatility on the left. So that's just one commodity. On the right, the chart looks at our total trade balance. The orange line is if we exclude non-monetary gold and other precious metals, it's relatively stable, mainly in deficit, with a couple of small surpluses, but some incredibly volatile movements. Beginning of 2019, end of 2019, 2020, there are other factors at play as well. But there are times of great economic uncertainty. Some of these were close to some of the expected dates for the UK's departure from the European Union, and the overall trade balance was skewed largely by the impact of non-monetary gold and other precious metals. Should be said, this is neutral on GDP because it offsets between valuables and trading goods, but the compositional breakdowns of GDP are of course affected as well. So what's happened recently with gold? Why is this different? So this is the gold price. This goes back, hopefully you can see on the chart, goes all the way back to 1970. And apart from a spike around about 1979-80, the price was relatively stable up until just before around about the time of the financial crash, 07-08, where suddenly we've got a massively increased price, more volatile price, and of course that makes it more attractive than speculation, and some of the behavior around the holdings of gold have changed. But also our other issue comes into play around cryptos. Obviously the best known of those is Bitcoin, but there are lots of different cryptos of lots of different types. We'll talk a little bit more about those in subsequent slides. And as you can see, you probably expect this, the value and the volume of Bitcoin traded has been extremely volatile from about 2017 onwards. This only goes up to 2020. It could go on to 2021. We've seen big price increases recently, but again, volatile fluctuations in the price and the volume of Bitcoin. So there have been lots of discussions at international level about how we should treat these, the OECD, the IMF, and so on. And looking at the crypto side of things, there have been a variety of suggestions made about how we should treat the different types. So where they're backed up by used as a means of exchange, backed up by monetary authorities, the suggestion is to treat them as currency, which makes obvious sense. But those that are acting as a means of payment without a liability, there's a suggestion of a new category within currency and deposits, with or without a corresponding liability. Payment tokens with or without a corresponding liability could be treated as either debt securities, or if there's no liability, they're not classed as an asset. Debt security cryptos will be classed as debt securities. Equities, likewise, and the relevant asset and derivatives again. Crypto assets with a liability, which act as a store of value, will be classed as debt securities. And then there's the ones which act as a store of value with no corresponding liability. The suggestion was to treat these as a new category, new subcategory within valuables in the non-financial account. But as I say, this was an initial proposal. The conversations are ongoing. So within ONS and the Bank of England, we've come up with a proposed way forward, which broadly focused on two basic principles, two underlying principles, which drive the composition of the relevant parts of the accounts. So firstly, in the supply and use tables, items in there generally will contribute or would be generated by production or consumption, certainly the flows, not the stocks, but the flows would. And within the financial account, all assets should be balanced with a corresponding liability. There is already an exception there, which is monetary gold, where realistically there is no liability, although we sometimes treat a notional liability in the rest of the world. So we had a very long list of options, but by using those principles, we reduced that to, apologies for the numbering on the slide, it should be 1, 2, 3, and 4 options, which would be, and some of these comply, all of these will comply with at least one of those principles. So option 1 was that everything gets put into valuables, including monetary gold, non-monetary gold, other precious metals such as silver and platinum, various other classifications of valuables we have, so antiques, art, fine wines, and so on, and then the cryptos with no corresponding liability, so all in the same place. Equally, we looked at another option which said we put them all in the financial account. And then there are two quite similar options where we create a new valuables account away from the existing capital account, where we put most of these. And the different options there is either we do include or exclude monetary gold from that valuables account. And the subsequent slides will show what this actually looks like. So this is the existing sequence of accounts. The top account is the non-financial accounts from production down to capital, where you have in the capital account, you have gross capital formation, which includes the valuables as currently classified, including non-monetary gold. And then at the bottom, we've got the financial account with net acquisition of assets on the left and liabilities on the right. And monetary gold appears in the financial account, but it's the only gold that does. Okay, so that's where we currently are. So the new proposal and would be that the capital account now excludes valuables. Still has gross fixed capital formation, still has changes in inventories and all the other components, but we pull certain things out of the financial account as well. So monetary gold comes out, and acquisitions less disposals of valuables come from the capital account to provide a separate account. And the rationale here is that gold, when it's traded, is not traded like a non-financial asset. It's traded on financial markets. Compared with other types of valuables, it's the sheer volume of trades is enormous, and it's done in seconds. Where if you're trading in works of art and antiques and so forth, you might buy a Rembrandt and keep it for 50 years, and then yes, you might sell it on for a profit. But gold is bought and sold within seconds. It's not treated like it doesn't act very much like a non-financial asset. Sorry, let me get the words out. Apologies. So the overall impact on GDP will be nothing, because this is GDP neutral anyway, or negligible. It would smooth out the volatility in the trade balance to actually get through the underlying numbers. Now, there could be a question that says, well, actually, this doesn't affect many countries in terms of the non-monetary gold side of things, and that's true. It tends to affect countries like the UK with big gold exchanges, but the crypto assets issue, we don't know who that's going to affect. That could affect almost any country anywhere, and could have enormously difficult to interpret movements in their accounts, and make it very difficult for policymakers to try to understand what's going on. So we recognise that this possibly isn't a perfect proposal, but it moves us in the direction of what's actually happening in the world. So key thing is there is no agreed current treatment for cryptos. So when anything we develop is going to be new, and we believe that the current treatment of gold is unsatisfactory. It distorts the numbers and doesn't reflect what's going on. So we do need to develop a new coherent proposition. We want to address various outstanding issues whilst protecting key principles around both the non-financial account and the financial account. So our proposal there is for a new store of wealth account, which will sit within the financial account. We recognise that this will have some non-financial assets in there, but broadly this will be dominated by the movements in the financial assets if we classify cryptos and non-monetary currently non-monetary gold within that area. Okay. So I must have got through that quite quickly because I haven't had my 15-minute warning from Leonard yet. So I'm going to stop sharing and hand over to Leonard for questions.
Okay, thanks very much, Pete. Yes, you went very quickly. You didn't make it to the 15-minute mark, but that gives us lots of time for Q&A. Now, so far, unfortunately, we have no open questions, but I thought I would, Mark, you have a question.
Yes, I do, but of course, yeah, okay, so can I go first?
Yeah,
so,
sure.
I think I actually have one or two. So this is, okay, funny enough, I have some papers on economics of Bitcoin published last year and the year before, I think. And I think, I'm not so sure if there's a relationship to what the presentation was about. But I think what I would like to at least throw into the discussion is, so in the presentation earlier, so it has been highlighted that there are sort of two types of holders of gold. So those who just hold it for whatever speculative purposes, and those who use it for industrial use. So I think the same also applies to crypto assets. So some actually use it for paying. And maybe this is then also actually the main purpose why they are holding this. And of course, others are just using this for, again, speculative purposes. So that would be maybe my first point. So is this going to be taken into account in some way, or would it be useful to take this into account? And then, okay, I have a second question. So one of these papers I just referred to. That paper tries to discuss a little bit this question of what is the fundamental value of crypto assets, well, so because I think okay, so that's somehow one of my, so that's one of the questions I'm really interested a lot also in context of other financial markets. So what do prices reflect? And of course, many people, so when you talk about crypto assets, or when you hear discussions about crypto assets, many people say, yeah, that's a bubble. So there's a Bitcoin bubble because the actual value of Bitcoin is zero. So the fundamental value is zero. Okay, but then at the same time, fiat currency in a way also doesn't really have that value. But then at the same time, there's this traditional economic argument saying, well, fiat currencies allow people to make transactions, and this contributes to some sort of fundamental value.
Mark, there are now some other questions. So
okay, I'm sorry. Okay, so this is yeah, maybe we can discuss this later. But anyway, so I just wanted to throw this in. So maybe this is also something that can be taken into account. Okay, thank you.
Okay, Rachel Soloveichik has a question, and afterward, Grant Fitzner has a question. Rachel, would you like to answer this question live?
Can you hear me?
Yes.
So my question with gold, or all this stuff, is it just changing, you know, who owns a bar in the London like exchanges, or is it actual physical gold moving in or out of the country?
And Grant, would you like to?
Yes, I would, Leonard. Thank you. My question is, look, I think, Pete, you've made quite a seductive case here for change, and it all seems simple and obvious, but I'm sure some people have or are likely to raise objections. So, because this is a significant change to the national accounts framework, and I'm just thinking, so far in terms of your discussions with colleagues in other national statistical institutes and elsewhere, what are the likely objections or concerns that people might have with this new approach?
Okay, okay. Let me ask one additional, which is, how would this treatment allow for government cryptocurrency, which is going to be a very big deal, it looks like. Thank you. And now the floor is yours, Pete.
Okay. Thank you, Leonard, and thanks to everyone for the questions. Mark, in terms of the, as you said, fiat currency in response to the point about the intrinsic value of Bitcoin, you took the words out of my mouth, because that's exactly what I was thinking. It has a value because people accept it has a value, but it doesn't have anything intrinsic of its own on its own. But yeah, the things you said it was useful to take into account, I completely agree. The discussions are very much ongoing with cryptos, and really useful points. Rachel, yes. Who is it? A change in who owns the gold, or is it actually physically moving? Certainly, in the case of the United Kingdom, primarily it's the former. It's ownership of bars of gold on the London exchanges. That's the biggest impact there.
Is there any, Pete, Rachel had another part to that question, which is there another, any data on physical movements of gold?
Most of the data we get are through our colleagues at the Bank of England, and that's mainly about the traders on the London markets. Physical movement we would have to get through our colleagues at Her Majesty's Revenue and Customs, so there would be data on there. I don't have to hand a breakdown between the two.
That's fine.
The majority is through the exchanges. But thanks for the follow up. Grant, in terms of possible objections, one clear one is this creation of a category of assets with no financial assets with no liability. Now, whilst we've got monetary gold as an exception, and there are arguments that fiat currency come under the same thing, although that's disputed, that is a clear possible objection. And there are always the issues about when something's produced, is it valuable then, or does it become valuable later? In the case of a work of art, it's when the market decides it becomes valuable. And some other things will be based on age. But clearly, whilst we're extracting gold, it's just a produced good, then it becomes valuable. And there are other questions around things like Bitcoin mining as well, which I haven't covered today. But that's a separate issue. It's something that's produced, if you believe that, and then is converted to an asset. So I think the biggest objection will be around the sort of the integrity of the financial account in terms of assets and liabilities equaling. And Leonard, government cryptos, yes. I mean, I had a list of different types of cryptos on that table. I didn't mention government cryptos, but that's something else to come into the discussions. And if these are backed up with liabilities, they kind of sound more like the currency type of thing. But they could also fall into one of those other categories that was listed on there as well. But it's that's one that we haven't spent so much time talking about, the government cryptos, but I suspect that's looming large on the horizon in terms of things we'll be looking at very soon.
Okay, I see no further questions. So with that, I will turn it over to Mark Grunwald for his presentation.
Yes, okay, thank you very much. Okay, let me try to share my screen. So I guess this should work, isn't it? Okay, thank you very much for the nice introduction, Leonard, and also thanks to the organizers for having me here. So I'm very happy to have a chance to present this this paper. So this is okay. It is about measuring oil market uncertainty, and we are playing a lot with Google Trends here. Okay, so that is Esti. So she's a PhD student. So she's involved in this project. And also maybe I guess I need to make one little correction. So I'm with XJTLU, so that's Xi'anjiaotong Liverpool University. So of course Liverpool University is heavily involved here, but we do have so we are a collaborative university jointly run by Liverpool University and Xi'anjiaotong University. So I guess the Chinese partner would be a little bit unhappy if we are ignoring them here. Anyway, so this is so that's the paper. Okay, what do we try to do? Okay, so it is about measuring uncertainty, and in particular, we are interested in uncertainty related to the crude oil market. And as I already indicated, we are applying Google Trends, or basically Google searches. So we are working with search activity on Google. So that's the basis. Okay, what we try to do is the following. We try to propose different types of oil market specific uncertainty indices. So that's what we try. Okay, well, given that there is an extensive literature on other types of uncertainty measures, of course, we also have a comparison of what we propose with what already exists. And then in the third step, we are analyzing what is the effect of different types of uncertainty on some oil market specific variables. So that's what we do. But what I also want to highlight is that, okay, I think we are not really at, so the paper is, that's still work in progress. And I think the more we are thinking about what we are doing is actually, so I'm actually thinking, so what exactly are we measuring? So that's a question which gets a bit more prominent. So I think, so for those who expect, so the session title is solutions. So I don't think that we have the solution yet. So apologies for that, but I hope that's still going to be an entertaining presentation here. Okay, so that's what we try to do in the paper. Okay, so as I just highlighted, there are a number of recently proposed uncertainty measures. Okay, funny enough, one is actually the oil volatility index, which essentially measures how volatile is the oil price. So it's near month futures price volatility of crude oil. So, and this is considered one uncertainty measure, so sort of an income, so financial uncertainty, macroeconomic uncertainty, whatever. Okay, so in addition to this, Jurado and his co-authors in the AER proposed, okay, they actually proposed different types of uncertainty measures. So it's a macro uncertainty measure and also a financial uncertainty measure. And they basically extract information from a data-rich environment. So they do have a lot of macro and also financial indicators, and extracting information from that, they convert into at least two different uncertainty measures. So Baker's QGE paper, Baker and Al's QGE paper, is about measuring economic policy uncertainty. Well, and they do also, they apply this popular method about of going through US newspaper articles and then essentially count how often terms such as economy or uncertainty or Congress or other sort of terms are used in newspaper articles. And then another also recently proposed measure, I think that is still a working paper. So it's the so-called World Uncertainty Index. So this is simply the frequency of the term uncertainty in those quarterly Economist Intelligence Unit country reports. Okay, so these are the existing uncertainty measures. And I think it is useful to show, to give you an overview of how these measures look like. So now I will just show you a few graphs. So in these graphs, in this orange or yellowish orange color, you see the respective uncertainty indices. So oil volatility index on the left panel and financial, so Jurado's financial uncertainty on the right panel. And then I'm plotting this together with the oil price. So simply the oil price in levels, nominal oil prices in levels. So first, well, obviously the oil volatility index, well, unsurprisingly, that measure is going up whenever the oil price is volatile. So this financial uncertainty measure, maybe also unsurprisingly, that peaks 2009 around the global financial crisis, then it goes up and down a little bit. Evidently and unsurprisingly, there's a peak in that measure in early 2020 as well. but there is already some sort of an upward trend emerging or starting maybe in around 2017, 2018. So financial uncertainty seems to be increasing. Seems start to increase prior to the outbreak of the pandemic. And if we also compare this to the oil price, well, obviously, as I just said, whenever the oil price is volatile, then this index is volatile. But then also it seems to be the case that at least there seems to be some sort of a relationship. Of course, I'm not making causal statements at this point that the crude oil price causes financial uncertainty. This I'm not going to make, but at least there seems to be some sort of a relationship. When the oil price, when there's something going on in the oil price, then also the financial uncertainty measure is somehow showing some interesting movements, let's put it this way. Okay, the remaining two policy measures, so they look a little bit different, and also the relationship to the price of oil seems to be a little bit weaker. So Baker's economic policy uncertainty, well, yeah, it's going up and down all the time. Also, there's some sort of persistent increase starting around 2016. Obviously, it is particularly high in 2020 for obvious reasons, but also there, so it's some sort of a long-term increase we observe. And as I said before, so it's not always related to oil price movements. The World Uncertainty Index, I think overall looks similar, also quite high, around early 2020. Also some fluctuations which are more or less unrelated to oil price fluctuations. So anyway, so these are the existing uncertainty indices, and I think it's useful to give this overview here at this point. Okay, now, well, of course, maybe unsurprisingly, we are not the first to work with Google Trends. So Castelnuovo and Tran in 2017 in this economics letters paper, they propose an uncertainty measure using Google Trends for the United States and Australia, and then so they propose this measure, and then they sort of also analyze how that uncertainty measure affects certain macro and financial variables. Following up on that, Tran et al. Proposes an additional uncertainty measure for New Zealand. Bilgin et al. Propose one for Turkey. So while I think overall this all is not surprising, while Google Trends is easy to use, and then of course it makes a lot of sense to propose these type of uncertainty measures also for other countries. Also, we are not the first to use Google search volumes for oil price. So there's at least this one energy economics paper from 2018. But what I want to highlight is that paper interprets these Google searches as investor sentiment. And I think, I'm not sure if we agree with that assessment, because, well, ultimately I think it's the more general public who is using Google rather than so oil market investors. So this is probably something we would disagree with. But anyway, so that's another paper which is at least, of course, also related to what we do. So just to briefly try to explain this procedure Castelnuovo and Tran are using. So they use a broad set of keywords which are supposed to measure uncertainty about future economic conditions. So examples are bankruptcy, stock market, economic reform, debt stabilization, and so on. Okay, they extract search volumes from Google and then transform this into one index. Okay, and for those of you who are familiar with Google Trends, so you can only use up to 5 search terms at a time. So this is why, so otherwise the comparison of those search volumes is very, very difficult. So this is why you always have to select one benchmark term. And that is, of course, what Castelnuovo and Tran are doing. And then, as I said, what they get out of this is interpreted as an uncertainty index. Okay, we try to measure oil market uncertainty. This is what I already said. So, so not just oil market uncertainty in general. So we try to sort of create different types of uncertainty indices. One for oil investment uncertainty, one for oil demand uncertainty, and then also one for oil supply uncertainty. And what I'm listing here are keywords we are using, so search terms. Oil drilling, oil exploration, We hope that this captures oil investment sort of activity or uncertainty. Of course, demand uncertainty would be recession, growth, economy, these type of things. And then oil supply uncertainty, maybe shale oil and OPEC. So these type of search terms should somehow be related to oil supply uncertainty. But then evidently, whether or not these attempts are successful, of course, is determined by whether or not these search terms are sensible or useful. Okay, we also use a benchmark. So the oil price, so search term oil price is our benchmark measure. And then in addition to this, we also use just the simple search term oil price without these additional search terms here as one very simple oil market uncertainty measure. Again, even though we still don't really know if it's an oil market uncertainty measure, but that's what we also do. Okay, and this graph here shows you search activity. So Google search activity for oil price. So again, it's the search term oil price. And also for those who are not familiar with Google Trends, so you never get absolute numbers. So all you get is relative numbers over time. So you specify a certain period, and Google allows you to go back to 2004. And then you get a time series. So the maximum will always be 100. And so this means you only have some sort of a relative measure. So and what we can see here is in early 2020, the search volume for oil price was the highest. So there are also peaks around 2009 and then peaks around 2014, 2016. So, and if you plot this together with the oil price, okay, again, so apologies for switching colors here. I think this is what I'm doing on occasion here. Again, apologies for this. So if we plot this together with the oil price, then I think that's probably the first surprising, the first surprising insight. So people seem to be more interested in the price of oil when the price of oil is going down. So here, this price collapse, 2008. So that's when oil, when searches peak, and then also 2014, the downturn in the oil market. So this is also when oil price, so searches for oil price peak, and then obviously in early 2020, when the oil price was when WTI was negative for a day or so. So this is also then when these searches peak. And what I also find remarkable is there's some sort of this shift, some sort of a level shift. So apart from this crazy period, the oil price, so searches for oil price were relatively stable, relatively low, up until 2014, 2015, and then they went up, and then sort of they remained a little bit higher throughout the period. Okay, so I want to compare this. So I want to compare these Google searches with those existing uncertainty measures. And also there I think there's some interesting patterns. I'm actually quite surprised that in particular here, the top right panel here, there seems to be a relatively strong relationship between the financial uncertainty measure by Jurado et al. And these simple Google searches for oil price. So I find this is sort of remarkably close. Obviously, there's also a relationship between that and so oil price volatility. And then again, sort of maybe similar to what I said before, Google searches for oil price are less related, I find, to these other uncertainty measures, even though on occasion some peaks still overlap. But anyway, so that is the comparison with those existing measures. Okay, as I said, we try to propose a number of oil uncertainty measures, and this graph shows you the four we have. So there's simply the Google searches for oil prices in blue, and then oil supply uncertainty, oil investment uncertainty, and oil demand uncertainty in orange, green, and red. Well, so they all look somehow, okay, I find, well, so there are differences in level. So oil investment uncertainty for some reason is always above the others. But apart from this, the overall pattern is relatively similar. And that of course is determined by this benchmark, because as I said, we use this benchmark. So this is why all these uncertainty measures are relatively similar. So and we are still, so as I said, so that's still work in progress. We are still working on this, and so ideally, so maybe I was hoping that these measures are a little bit more different from each other, because then maybe sort of whatever the explanatory power they have might be a little bit higher. Okay, so that's maybe one of the key graphs here. So these different measures. Okay, I think there's still no 15-minute warning, so I guess I'm doing okay, I think. So as I said before, we are also interested in an empirical application, so we're not just proposing these measures. We also analyze what is the effect of oil market uncertainty or uncertainty in general on specific oil market variables. Okay, what we are looking at is so two key variables. So one is the oil price, and then another key variable we are interested in is rig counts. Okay, so why am I talking about rig counts?
5 minutes.
Okay, very good. So why am I talking about rig counts? So the thing is, crude oil production itself does not really respond to oil price changes. So this is simply because, so in particular, offshore oil production platforms, so they don't simply stop producing if the oil price goes down, or they simply cannot ramp up production if the oil price goes up. So this means in the short run, there isn't really a relationship between oil production and oil price changes. In the long run, of course, there is, but not really in the short run. So this is why it doesn't really make sense to analyze the effect of uncertainty on production. But there is a strong relationship between oil prices and rig counts. Okay, and rigs, so these are drilling rigs. So it basically rig counts are an indicator of exploration activity. So this means whenever there's drilling activity for a new oil field, so when people try to find new oil, then they're drilling these holes, and that is captured by these rig counts. And of course, today's exploration activity, well, of course, is really, really important, because whatever we find today in the future is going to be the oil production. So, but not only that, within the oil industry, I think the rig counts are also considered something like an oil market sentiment indicator. So when rig counts go up, so then this is usually considered a sign that, okay, the people in the oil industry, there's a positive sentiment. So people are making this type of investment because they think in the future, so it's going to be a profitable thing. Okay, and this graph, so this graph shows you the relationship between world rig count, so that's from Baker Hughes, a data provider, and oil price. So here we see this relatively strong relationship. Whenever the oil price, in this case in blue, whenever the oil price is going down, also the rig counts go down. And when the oil price goes up or is somehow stable, then also drilling activity is increasing. So also this graph, so I find this quite remarkable how strong this oil price decrease in 2014 affected drilling activities here. So we do observe this. We do observe this relationship here. Okay, so so this is supposed to show you why it's interesting to look at rig counts. Okay, just one slide on the empirical framework. So I don't really spend much time on this because this is all pretty standard. So we are using monthly data from 2005 till 2021. Because that's how far back our Google uncertainty measure, of course, goes. We just use a simple standard VAR model, so there's nothing really magic about this. We have 3 endogenous variables in the VAR, so the oil price, the rig count, and then one of those uncertainty measures. And of course, given that we have a number of those, we do have a number of VAR models, but each VAR only consists of 3 variables. And then we simply do impulse response analysis and also some granular causality test. Again, so that empirical part, so this is not really magic, but I think it's useful for what we want to do. So just one slide summarizing or giving you an idea of what the results look like. And so these are impulse response graphs. So and they all show you the response of rig counts to a shock. To a standard shock in one of these uncertainty measures. So oil price volatility, so an oil price volatility shock, so financial uncertainty shock, economic policy uncertainty shock, and then also the Google measure shock. So as we can see. There seems to be some sort of a response which is significant. So in the top right corner here, you see when there's a shock in the financial uncertainty or the macro uncertainty by Gerardo, the oil price, the oil rig count sort of seems to be responding negatively. There isn't that such a strong response here on the
one more minute.
Side. Yes, I'm about to conclude. Thank you very much. So but then we also observe that there's a tiny negative significant response of also the rig counts to a shock in this search volume. So search volumes, so when this public interest in oil prices goes up, okay, this is somehow negatively affecting the rig counts. Okay, this is my last slide. I'm going to conclude now. So we try to measure oil market uncertainty using Google Trends. So we do find that there is some relationship between uncertainty and oil market sentiment, but of course it's important, what is that type of uncertainty? I also find it interesting that oil price movements up and down seems to play a role and seems to determine whether or not the public is interested in oil prices. And again, we are still trying to figure what exactly are we measuring. So is it uncertainty or is it public attention or whatever? So, okay, I think that's all I wanted to say. Thank you very much for the attention. And now I look forward to the Q&A. I'm stop sharing my screen now. Thank you.
Thanks, Mark. In the Q&A, there is one question, and it's from Joseph Haynes. So Joseph, would you like to respond?
Yeah, well, it was actually a question for the first speaker. I'm not sure if we're still allowed to ask questions of that.
Go ahead, although it's not quite kosher.
No, I was just wondering if he was able to give a simple explanation of how the trades on the London gold market affect the volatility in the series of UK trade in valuables. I'm not quite sure how the market works, but if a Russian sells gold to an American via the London market, why would that necessarily impact UK valuables? Would it not just be a service fee in the accounts? Does there not have to be at some point some UK ownership of the gold to impact on the UK series of trade-in valuables?
Pete, would you like to respond to that briefly?
Yeah, yes, that's fine. I can do that very, very briefly. Yeah, Joseph, you're absolutely correct. If it's just between two non-residents, yes, there's any service fees included will be part of it, and they won't be particularly volatile. But if it's a UK resident selling to a non-UK resident or vice versa, that's where the volatility comes in, and there's an awful lot of that going on.
But then why does the UK have? So this is my not understanding the situation probably. Why does the UK seem to have so many UK residents selling gold, whereas other countries don't have that?
Well, we have the traders as well who are selling as well. So there is an element there. So people buy on the London markets who are UK residents and then sell it on very quickly. In addition to that, you've got all the service charges and so on as well. But there's an awful lot of UK resident involvement in the trades on the London markets, and it's a big market as well. So it's likely to be the case.
Okay, thanks.
Thanks.
Thank you. So, Mark, I have a question, which is, I'm wondering whether part of why there are more Google searches when the price is falling is because there's an asymmetry, at least in the United States market, which is the one I'm familiar with, which is that when international oil prices fall, the gasoline price at the pump goes down slower than when the price rises. So I wonder whether people are asking this question because they see that some newspaper headline that says, oil prices fallen, and they want to know, well, is it going to fall in my neighborhood, kind of. And it might be interesting if you could sample some of the queries somehow.
Okay, yeah. Okay, this is a very good point. Maybe people are simply interested in Yeah, so so how much is the oil price falling, and or what is going on in the oil market, and will it translate into gasoline price decreases as well? Yes. So okay, I'm not sure if we can sample. Okay, I think what we can do is, I think Google allows you to check where people are, at least those who are revealing where they are based. So I think there's a spatial distribution of where these searches. So okay, so this is world. Okay, the data I showed you is, so that's worldwide. So I did not only look into Google searches from one specific country. So this is basically, so wherever people in the world use Google, so that's included in that data. But yeah, okay, maybe it would be an interesting, point. Maybe this is somehow simply because they are sort of, it's related to sort of whatever payments, maybe also heating, when they buy heating oil.
Right.
At some point, people are buying heating oil. Maybe then they're also interested in the oil market. Anyway, okay, yeah, so that's a good point. I will think about this. Thank you very much.
So does the audience have any further questions? All right, well, thank you, Mark. And I will give my presentation. If I can figure out how to do this.
And I will give you 15-minute and 19-minute warnings, Leonard.
I guess one of us should do that,
great.
isn't it?
Okay, well, thank you very much to you all. I'm very glad to be presenting this paper, which I'm still in the midst of revising. So I will really appreciate any questions and answers here. Also, these are my opinions and not those of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. Okay, and I'm going to be talking about what I think is evidence of accelerating mismeasurement in the 21st century. And really, what I'm talking about is how ignorant we economists now are about true inflation and growth, that the 21st century economy makes measuring growth more difficult. We have lots of new products and free products due to very rapid innovation. And along with that, our products are not just new, but they evolve once they come out. And the same thing is true of our markets and our business models. So what I do in this paper is collect recent research and evidence on the acceleration of mismeasurement. And I'm comparing the period of roughly 1983 to 95 to roughly 2005, 2017. And what I find is faster growth and slower inflation. And in 1983 to 95, I see about a 1% mismeasurement in the categories that I've selected. From 2005 to 2017, I see 2% mismeasurement. So that 1% mismeasurement around 1990 is more or less in line with what the Boskin Commission thought. And I'm arguing that mismeasurement has gotten worse, not better in the interim. So my best guess, which is really quite crude, is that productivity growth is strong and that prices are deflating in the US and not incidentally also around the world. So the puzzle is that we have fast corporations, slow growth. So we have very large corporate investments in innovation that generate very highly profitable, innovative products. But historically weak GDP growth per capita and real interest rates. These successful innovations are obviously not showing up in GDP. why. So I'm going to start out by looking at the big four internet corporations that are now nearly a fifth of the market cap of the S&P 500, and see how they show up or don't show up in GDP. And I gather many recent studies of products and investments by other corporations. And I show that national account statistics fail to capture the benefits of innovations, and that these errors have accelerated as our rate of innovation has accelerated. Ultimately, I'm going to be arguing we may be growing too fast, not too slowly, and that the economy is changing at rates that households in all our institutions are having trouble adapting to. So let's think about an innovation which is on our minds a lot, which is COVID vaccines. So what is the real value of COVID vaccines for the US economy? Well, basically, the cost is about $40 for each complete vaccination. So if we're going to vaccinate all 350 million US residents, that would be about $14 billion. But what is its inflation rate? Well, we measure inflation rates from period to period. So we need to compute some kind of shadow value for the COVID vaccine as of 2020, since it didn't exist back then. So we could ask the question, what would Americans have paid to get our jabs last year? Well, I don't know. I mean, when I introspect, I would think I would have paid maybe $10,000 or so, but the value to US consumers must surely average more than $500 each. But even with that relatively low valuation, that's worth $175 billion in 2021. That number alone would add nearly a percentage point to real GDP growth and reduce the inflation rate by 0.8%. But there are several ways to calculate this rate of inflation in real growth. I mean, another thing is that, if we didn't have the vaccine, what would be the impact on our economy? It would be enormous. It would be in the trillions of dollars. So, this is recorded only at resource cost in the GDP, so there's no impact on real output. All right, so let's think about this. We know that COVID vaccines were produced very, very quickly compared to the past. It took just about a year, where normally you would think it would take a decade. But so that's a tremendous economic accomplishment, and it's due to corporate and government innovativeness. But as measured in our accounts, US pharmaceuticals industry productivity is declining more than 2% a year. Well, maybe that's because we don't include things like the real value of vaccines and pharmaceuticals. But a single product can have a huge impact, and that's quite typical of innovations. Innovations have very fat tails. US corporate investments in intangibles have quadrupled since the 1950s. As BEA measures them, investment in intellectual property went from 1% of GDP to 4%. Crotto et al. And my estimates are roughly 3 times as large, and we now according to our estimates, we now invest more, corporations invest more in intangibles than intangibles. Colley and Stoltz, analyzing corporate balance sheets, show that the average US corporation is now investing more in R&D alone than in intangibles. These large innovations have resulted in a huge increase in after-tax economic profits as a percent of GDP. They were running about 6% for about 5 decades. Now they've jumped up to around 9%. And that's even before this latest run-up. So why do we have such big measurement problems? And the basic problem was just illustrated with the innovation of the COVID vaccines, that we have a missing transaction. There is no transaction in COVID vaccine in early 2020. And we economists like transactions, right? We're trained on supply and demand curves. We rely on transactions to deliver prices and quantities for us to measure. And we distrust shadow prices, which don't tell us, there's no revelation of value in shadow prices. So we measure inflation as a change of price of a very specific good, which we believe is unchanged over time. When new goods appear, they don't have a prior period price. So you need a shadow price. It's hard to calculate. What is the shadow price of COVID vaccine in early 2020? And incidentally, another problem is that goods change in their value over time, in their utility over time. So a COVID vaccine in early 2020 would have been more useful than a COVID vaccine in early 2021. Intangibles are created in-house. So unlike plant and equipment, which are usually purchased at arm's length. So there's no visible transaction. That makes it much harder to create nominal and price measures, and we have essentially given up. So intangible investment has been replacing tangible investment. And tangible investment, we've had a lot of price declines in. But in official GDP, we deflate intangibles with input costs and add back in average productivity, so there's no net impact on productivity. I'm going to show that intangible investment prices are falling rapidly, but they're unrecorded in our GDP accounts. So as intangibles replace tangibles, we get less deflation. Data is a new intangible investment, not in GDP. As we've just seen, we don't know how to handle cryptocurrency and whether it's an investment or not, even though it takes some GDP resources. Intangible assets are not tied down geographically, unlike tangible assets. So Apple can export its intellectual property to Ireland without a transaction. The domestic part of gross domestic product becomes harder to measure. For consumption, consumption has changed with all these new products since 2005. Consumers love all these new varieties, and product variety is accelerating. And, innovative products have always been hard to quantify. Another problem is that zero resource cost products are rapidly replacing costly products. With Internet 2.0, everything that can be digitized to zero reproduction cost, often zero price. consumers consume information and novelty, which are often digitizable. And we don't know what units to measure these things in. So has mismeasurement accelerated? Well, one sign is that there's more rapid turnover of products in the market. So let's think about the CPI survey, right? So the BLS selects products to put in the CPI survey, very particular products. And when it looked at those products in 1983 and 1995, it found that the products were permanently disappearing on average in 25 months from the survey. But when it checked again in 2015, it found they disappeared in 20 months. So between 1995 and 2015, the product disappearance rate increased by 25%. And our standard procedures don't measure quality improvements when new products appear or when existing products change. For example, an hour of a doctor's time or an hour in a classroom, those are different products than they were in 1965. So we need custom ways to deal with these problems, but there are too many products. So let's look at the big four internet firms. In 2017, these accounted for 13% of all US corporate R&D. So these four firms had basically an eighth of all US corporate R&D. Their profits from 2007 to 2017 increased by $72 billion, right? So there was that big increase in US corporate after-tax profits. Well, that went up by $400 billion. So these guys account for 18% of the increase in profits. And Apple, Google, Amazon, and Facebook, they've come
5 minutes.
Thank you. A tremendous number of products that have been very widely used and all adopted very, very quickly over the last 15 years. So all during this period where we've had very slow growth as measured. So, basically, how can we have big profits, fast change, and slow measured growth? Well, the consumer products of Google, Facebook, and Amazon and Apple don't appear in GDP, but they show up as decreases in PCE. So they're Facebook and Google make free products. Google Search, Facebook, these things are free. You pay for them with ads, but zero prices for these free products are incompatible with inflation and output measures. And free products replace tangible merchandise such as CDs and film. So you don't need a CD, you go to YouTube. You don't need to process your film, you go to Instagram to send it around. Amazon, we know that there are lower prices at Amazon, but those lower prices don't show up as deflation as a result of new outlet bias. But so Amazon's lower prices show up as reduced retail services. But Amazon delivers to your home. So as Amazon has become larger and larger in retail services, that's shrunk GDP. Outsourcing. Apple looks like an importing wholesaler in economic statistics. So iPhones show up in PCE, but they're all imported from China. So they're not, so they're subtracted back out from US GDP. Also, its intellectual property is recorded in Ireland. So between 1995 and 2017, PCE growth mismeasurement accelerated by 0.8% a year due to the internet. You can get that using Goolsby and Kleenow's calculation, using Byrne and Corrado's. You can use it Abdirahman and others, and Brynjolfsson and others all show that its understatement is this bad or worse. Aghion et al. Add another 0.1% for new outlet bias. Neiman and Vavra look at non-durable goods variety, and that adds another 0.03%. Pharma loans, probably a 0.1% acceleration. There are just lots and lots of big price drops. So Moore's law, we know a big annual, I'm going to go over, but we have a bunch of time to the session, so I think I still have a fair amount of time for Q&A. Consumer internet bytes have risen at 40% annually, cellular bytes at 60% annually, DNA sequencing 100% annually, DNA manipulation since 2012, about 130%. Startup cloud computing has gotten much cheaper. Rocket development from SpaceX has been phenomenally good. AI has had very rapid rates of increase, LIDAR, LEDs. The price of a complete human genome sequence fell 10,000 times from 2005 to 2017. We now have more than 1 million human genomes sequenced. We have Illumina's valuation of $40 billion. Illumina was the main pusher of human genome sequencing, the second generation. And the Illumina process resulted in a parallel fall in the price of sequencing coronaviruses, which has been enormously valuable in tracking the pandemic. From 2012 to 2018, there was a huge decrease in genome editing costs. So I add up all this stuff and I get a 1.2% rate of mismeasurement in GDP and from 1983 to, I'm sorry, that's 95. From 2005 to 2017, I have 2.3% mismeasurement. So that's an acceleration of 1.1%. So basically, this is a pretty big error. We really misdiagnose our economists. This is something that we really need to work on. I think we're going to need at least 2 measures of GDP, and we're going to need the profession to deeply engage with measurement problems. I do want to point out that a lot of people are unhappy. There are deaths of despair rising. And I think that it's super fast change that's the problem, not slow growth. Think of the social and ethical problems that are caused by our speed. The big thing is the high cost and rapid depreciation of human capital, right? If you don't have a college degree, you really lose out in this economy. Two-way mass communication has created huge social problems. Genome manipulation is very scary. The ethical issues of robots, self-driving cars and drones. We have space commercial exploitation getting ready to go on, but there are no current laws for handling that. But we are starting to militarize space. Brain-machine interfaces, there's little regulation. Inequality, striking inequality has arisen from this rate of innovation. And then we have climate and social change. So anyway, I'm going to essentially stop there. Let me just say that it's not the statistical agencies that are at fault. They need much, much more money and much, much more help from us. The US Statistical Agency, the UK Statistical Agencies, these are the best in the world. It's not their fault. Anyway, thank you for allowing me to overdo my time. If there are any questions, I'd be
Okay. Thank you, Leonard. And if anybody has any questions, can they put them in the Q&A? And on behalf of the ONS, thank you for those few kind words at the end there. We have a question from Andrew Baldwin. So Andrew, you can go ahead.
Hello, Leonard. Nice to see you again. I wondered if you would agree that the treatment of seasonal goods in the US CPI discourages the use of shadow prices there. It was Bureau of Labor Statistics economist Doris Rothwell who gave her name to the Rothwell formula, a monthly basket formula with annual base prices for seasonal goods. It is currently used in the CPIs for the Netherlands and Japan. When a seasonal good is unavailable because of drought or whatever, in a month where it would generally have a price, a shadow price must be assigned. If it had been adopted in the US CPI, there would have been much more experience evolving and calculating shadow prices. Instead, group imputation has been used for seasonally disappearing products in the US CPI and most other countries' CPIs. Has not this inhibited the use of shadow prices from being used in other cases, like the price of COVID-19 vaccines? Thank you.
Thank you. And we also have a question from Holly Hickman. Holly, you're muted. And we also have a question. Holly, can you? Holly might be having some troubles. We've also got a question from Bernhard Goldhammer and then from Richard Hayes.
Okay, why don't we come back to Holly when she's unmuted herself, or you can ask her question.
Yeah.
So,
okay, Bernhard.
So hi, here's Bernhard Goldhammer from the European Central Bank. You said at the end, maybe statistical agencies need much more help from us. Actually, what I believe, because first I worked for a statistical agency, the German one, and now I work for the European Central Bank. I think what is needed is a better collaboration and understanding between economists and statisticians in general. Because when you look at the papers you cited, like Goolsby-Kleno, or the Agion paper, both have a substantial lack of statistical knowledge. So Guzbiclino suffers from chain drift, and this is why he gets his amazing result. And Agion actually, he compares, let's call it a measure of the real world, at least with real data, with the CPI, to a hypothetical model. And then he says, oh, the statistics are wrong. So at the end, I think what is really important is to get a better understanding. And this is something that we can see somehow in Europe, so that there's a really good collaboration between the European statistical system and the European system of central banks. So we from the ECB always act as participants in the working groups of the price statisticians, and they take, we get a better understanding of the methods. And they also take on board many concerns or ideas that we have. So I think this is the way forward. Thank you.
Okay, I've seen a message from Holly saying there is no working microphone on the device. So I will read Holly's question and then I will go to Richard Hayes. So Holly's question, we are a growth-driven society, but do you not think it is the expectation of growth and constantly needing more that is making people unhappy, not the fast pace of change? We are told we need better jobs, better houses, better cars, and then are unsatisfied when we do not get it. Okay, and then Richard.
Hello, can you hear me?
Yes, Richard.
Good. Thank you, Leonard. Really interesting paper. My work in this area has often suggested that one of the problems here isn't just the way products change quickly, but also the way products blend and merge. And one can think of this as bundling, but is this also something that affects your results, and how would you deal with this? So I'm thinking about things like telephony contracts and TV, or the way we brought together data and telephony into a single product, effectively a mobile phone, where in trying to create that price for the predecessor good, you've kind of got to take account of the prices of various goods which all play a part in a modern mobile phone, whether it's the mapping service or whatever. So interested in your thoughts.
Okay, and then there are two more questions, Ruben Douglas and then Alexei Romanko. So Ruben, please. Okay, Ruben may be having some problems. So if I can go to Alexei and then we'll try to come back to Ruben.
Hi, Leonard. Thank you so much for your presentation. I was really inspired by that. So I was really inspired by some of your calculations for GDP mismeasurement. So my question have some short background. So I just run some silly calculations right now quickly. And it seems that, for example, CEO of Facebook, Mark Zuckerberg, alone invested in COVID vaccine treatment for setting up some R&D centers in California, around 2% of this year profits. And I compared this, percentage with U.S. government spent on COVID treatment, which is about 0.006% of 2020 GDP. So this background seems like Zuckerberg, cares about U.S. citizens around 1,000 times more. So my question is whether there are any other substantial problems beyond simple, let's say, recalculation of GDP trends that modern economists should care about, in the sense that some economic trends are far beyond our understanding.
Thank you, Alexei. Ruben, would you like to give your question? If not, I will read it out for you. You don't appear to be able to hear from Ruben, so I will read Ruben's question. Do we need to revise GDP measures to better capture economic activity which is socially valuable but less easily defined in productivity terms, such as social care and teaching? And that's all the questions we have, Leonard. So I will hand back to you.
Okay, so let me start with Holly's question about the demand growth-driven society, which I would agree we have a growth-driven society. On the other, but it's also true, I think, that in fact, we're getting a lot of growth. I mean, people say, oh, we're doing badly, and it's because people are in debt, right? And they fall into debt because of our crazy healthcare system in the United States, and they fall into debt because of our crazy educational system in the United States. But if you actually look at what people are spending on, they're buying all kinds of things that their parents couldn't have, right? So you go out on a US highway and half the cars are, twice the size they need to be. There's only one person driving in them, but it's an enormous truck that's, so we have, better cars and so on. I really, but the other thing is that, we misunderstand productivity also. The productivity in some sense is what, causes us to lose our jobs. And we're getting lots of job losses, but it doesn't show up in our measures. Anyway, I mean, I sympathize with thinking the wrong way out about economic activity, but I don't think that's our problem, really. Andrew, seasonal goods. Yeah, I think that, the problem of seasonal goods apparently goes back to Irving Fisher's conversations at the BLS in the early 1900s, when the BLS commissioner was concerned about the price of potatoes, and and Fisher convinced him that that could be handled without shadow prices, just sort of carrying through the existing prices. But yeah, I mean, the missing price problem has been with us forever. But I guess I would disagree in the sense that I don't know that our seasonal problems have gotten worse. They may have, but what I do think has gotten worse is that we have many more missing transactions. Oh, Holly, I should ask you, did I answer your question? Oh, anyway, you can type in if you didn't feel I answered your question. As for Andrew, yeah, I agree with you that shadow prices could be used more and probably should be used more in, monthly data for seasonal adjustment. And, and I think that in COVID, there's a big problem, because of a lot of products went missing, and that distorted prices. So, but does that answer your question, Andrew? I don't know, you might have been muted. But if I didn't, you can put something back up. Bernard, I entirely agree that there needs to be more collaboration between economists and statisticians, and that the statistical agencies, at least, in the United States and the UK, are being very active at bringing in economists, but even more of that needs to be done. Most of this work is done within the economic measurement community of economists, and we do need to get people like Agian and all these other guys involved, working closely with statisticians.
Oh, Leonard, it's Andrew again.
Okay.
Thanks very much for your response. Sorry, I wasn't at all aware that Irving Fisher had dealt with a seasonal problem in the 1900s. I think he gave the commissioner very bad advice, telling them that carry forward pricing was sufficient, and it would have been better to have a seasonal basket with shadow prices for goods that were exceptionally unavailable in season months. And I agree with you. I don't think seasonal problems have gotten worse over the decades, but I still think my point was maybe valid, that if advanced countries around the world had adopted the Rothwell formula for seasonal goods, there would have developed considerable expertise in the use of shadow pricing by agencies that could have been usefully applied in the case of COVID vaccine and other that you mentioned in connection with the pandemic. Thanks very much.
I agree entirely with that statement.
Thank you.
Richard, yes, bundling and products blending and merging is hugely important. And when telecommunications were almost entirely around the transmission of voice, the number of minutes that you were online, that you were in communication, made a lot of sense as a measure. But now that the product has changed so much, the bytes matter much, much more. And but a similar problem relates to a subscription to Spotify or to Costco or Amazon Prime. The value of those products has changed enormously as these platforms have changed. Amazon Prime now gives you all kinds of online viewing products. So yes, it's an extremely challenging environment. Richard, did I answer your question?
Yes, I think so. I completely agree. We think a lot about products sometimes in quite traditional ways, and we need to make sure we keep up with the innovation in the way the products are actually interacting, as well as thinking about innovative ways of tracking the price of individual products. Thank you.
Thanks. Ruben, yes. Economic activity that is socially valuable but less easily defined in productivity terms, social care, teaching, etc. Absolutely. I mean, if I think back to how I learned econometrics back in the 1960s, I did it on an IBM 1620 with punch cards and running a two-variable regression, two right-hand side variables, took some work. And that's without, adjusting for clusters or whatever. Social care, therapy of all kinds, physical therapists can do amazing things these days. Anyway, absolutely. And we don't really have an answer for a lot of these things, but but we could, try to get some crude estimates of these things, by questioning patients or questioning students, and asking them what they've learned or how they've appreciated the process or whatever, as well as we can have indirect results in terms of the wages you get as a result of taking some course, or the longevity that arises from certain kinds of care, or your with physical therapy, we can measure what capabilities you have, physical capabilities. So there are ways to go after these things, but it's not prices, and the focus on price alone doesn't get you there. Another big thing that Diane Coyle and I and others have pushed is impacts on our time allocation. Ruben, did I answer your question?
I think Ruben's been struggling to be heard.
Okay.
Something's just appeared in the Q&A. I'll check to see if that's a response. Yes, Ruben says yes, thank you.
Okay, thanks. Okay, Alexei, that was a very cute calculation, but I wouldn't argue that Zuckerberg cares more. I mean, Zuckerberg is one of these guys, as far as I can tell, who's is having a lot of problems caring enough. But the other thing about Zuckerberg is that he's got way too much money, right? I mean, $1 billion is more money than a person can spend in a lifetime, and to have 60 or $100 billion, it's just, that money is completely, its marginal utility is zero or quite possibly negative. So I don't think we learn much about his utility function from what he does with the money. The US government clearly could have invested more wisely. So there's a great anecdote in a recent issue of the journal Nature, where they were discussing efforts to create multivalent COVID vaccines. And apparently 3 years ago, in 1997, 3 top vaccine experts made an application to the National Institutes of Health to produce a multivalent coronavirus vaccine of the kind that they're now trying to do. And this likely, if it had been successful, it likely would have, given us a COVID vaccine in something close to earlier in 2020. So the response of the National Institute was that it was a beautiful proposal, that it was a brilliant idea, but that its scientific relevance was only moderate. So they didn't think that funding this would advance science very much. And so they, it didn't get funded. So clearly the scientists were thinking about the wrong kinds of relevance. But that's what scientists do. They need to answer the question that's most basic. And we need somebody else to ask the question of what's more important. And that's up to the governments. And to some extent, it's up to the economists, right? And one of the things that we as economists need to do is worry less about, what advances our science and worry more about the fact that our advice is causing the world to fall apart and go mad, right? I mean, my feeling is that the world that we live in, where we think we're growing very slowly, but have absolutely amazing rapid innovation that causes us to run as fast as we can just to try to keep up, and we're all falling further and further behind, that's driving us nuts as a society. And it's crucial that we correct this. Anyway, I'll stop bloviating and ask Alexei whether I actually answered his question. Alexei?
Yes, thank you. Thank you, Leonard, so much.
All right. All right. Well,
Okay.
Okay. So if there are no other questions, I want to thank
I'm
Mark.
not sure if I can still ask one. So I think we are way over time already. So I'm not sure what we are going to do.
We have 17 more minutes.
Okay, so then, well, if it's okay for everybody, then I just raise this. Okay, so one comment or question is, so you pointed out that both GDP and inflation are mismeasured. But now, so central banks, when they set monetary policy, then both GDP and inflation are variables they're looking at. So then the question is, does it mean that maybe monetary policy is not as good as it could be because it's based on sort of wrong data? And then the other question is, okay, so this is a bit lengthy. So this, your example of the COVID vaccine, I found this really interesting that So what would be the value or the willingness to pay for a COVID vaccine? So say last year or so, or maybe the year before last year. So I think I was just thinking about this a little bit. So I guess there are two factors. So one is, of course, so the individual benefit. So I myself, I don't get sick because of the vaccine, but then also, so publicly, so that means the more people are vaccinated, we no longer need these lockdowns and these type of policy measures. So, and of course, these are benefits. But then I'm just thinking, so some countries, so I think China, Australia, New Zealand, so these countries, I think they responded, of course, really, really early, and they basically closed their borders. And this also so had the same effect. So there are literally no cases of COVID in these respective countries, and they're not really lockdowns either. So now maybe my question is, so what is the value of a good government? Can we also measure this somehow? So I'm sure there's no answer, but I just wanted to raise this. Thank you very much.
Those are great points. I would argue that yes, that governments around the world are misunderstanding the rate of inflation, that, you know, because there are all these missing zero prices, that the true rate of inflation is much lower than we measure it to be. And in my paper, one of the examples I give is that when the Fed raised the Fed funds rate to 2.4% in early on, the yield curve started to invert, and the Fed was really surprised because at that point the our inflation measures showed 2% core inflation. So we should have had a very low real rate, under 1%, and thought we were being very supportive of the economy. I'm not speaking for the Fed here, but we had to eventually withdraw those rate increases. And when we look at our long-term interest rates, I mean, right now our 10-year rate is under 2%, or 30-year rate is under is also very low, under 2.5%. Are those really zero or negative real rates going out 10 years? Or, are we deflating, and are those represent, a real rate of a couple of percent? So yeah, I think not having these numbers right, it creates big problems for our monetary authorities. I mean, if you were to look at interest rates alone around the world, you would think that we were in a worldwide deflation, right? That's, we get interest rates like these only during periods of huge economic downturns and deflation. So, but we're not giving good macro policy advice. Everybody keeps saying, "Oh, we need to grow faster. We need to give more. We need to tax less and regulate less." Because the economy is just barely creeping along, right? And how could we give Mark Zuckerberg or Elon Musk greater incentives? Money means nothing to them, You know, I mean, we say we need to give entrepreneurs money so that they can do the next big thing. Well, Elon Musk set up Tesla and SpaceX and the Boring Company with less than $1 billion, right? That's $1 billion is a ton of money. You know, nobody needs to have 50 or $100 billion. And I don't see, you know, you look at these people and you ask, why are they continuing to do stuff? Well, they're doing it because it's fun and they enjoy it and they get prestige and people pay attention to themselves, but it's not because of the economic incentives. We need to tax these guys and reduce incentives because we're growing too fast. You know, we need to innovate in ways that are more sensible. We need, you know, how could the US be falling behind in green innovation if we have a good innovation system? And the answer is that, you know, we're not supporting that sector adequately. But anyway, enough of my soapbox. Thank you, Mark.
Okay, we have no more questions, Leonard. So I think I will hand back to you to close the session.
Okay. All right. Well, thanks very much. Thanks, Mark and Pete, for your terrific presentations on terrific topics. I think this was, if I do say so myself, a very good session. And thank you very much for the audience for hanging around. Anyway, thank you all. And with that, I'll end the session, or the host can end the session.